Hello YouTube. Welcome to the channel for all of those of you just now finding the video for the first time, and welcome back to those who've been here before and saw the first video. Today I want to talk a little bit about risk versus exposure. This is going to show you how it's kind of similar and the same when you're doing something like a linear type hedging strategy. If you are not familiar with just the basic hedge or the basic hedge structure, you may want to step back one video. I'll put a link on the screen here. You definitely want to be familiar with those basic concepts before moving on. But in this video, I want to show about how you would look at your risk in relation to your trade and what's going on in the market. All right. And before we get started here, I just have to go through one thing. No matter the strategy, method, system, or thought process, every trade has the same potential to win or lose. No results are ever typical and no results are ever promised or guaranteed. All trading is risky and you can lose your money very quickly. So act at your own risk. I'm not a financial advisor, I'm just some random person with a trading account. Alright, I'm going to hop into TradingView here real quick. I like to use TradingView a lot to really look at charts, prices, patterns. I can set up a lot of different things, look at a lot of different things, and I can get worked around real quick with the drawings. So I think this will be much easier to demonstrate and show what I'm talking about with risk. Another thing that we can do, once I find my favorites bar, there it is we can also measure things out. So I could use a little bit of numbering as well when I'm talking about things. So over here, we have our basic trade. So this is going to be your standard way of looking at risk. We're all probably pretty familiar with this, I would hope, at this point. In your trading journey, you should know your risk reward, how that's calculated based on percent of the account, or however you feel like you want to calculate that. So you've probably gotten a lot of practice with doing something like this. So like in a standard trade, you would risk that 22 pips and go for like a 1 to 5 risk reward and hope that you target these next high, the previous high or something like that to try to get your reward. Now, if you were going to do that same trade while hedging, and let's say you took an entry here and you were thinking price was going to go up, but you're going to hedge anyway, just in case. Well, let's say that price decides to start coming up a little bit more, kind of bounces around a little bit, but then comes out, and instead of getting your stop loss right here, you would have your hedge. And this would be the basic hedge that we were talking about in the previous video. So basically what you would want to do is at that point, normally you would close your hedge there and then you would have this small 22 pip risk. Now that's going to be in your drawdown along with the hedge trade that just made the gain on the account. So this way that's how your losses actually will get covered in hedging. Let me pull this up real quick. So basically every time that you get hedged, instead of the trade that's the hedge order making any kind of profit or gain to your equity, it's going to still go into your drawdown because it's going to cover at an equal rate the lost equity that you would normally lose in the hedge. So that's why I kind of made up this chart so we could kind of follow along with what's going on with our drawdown, where our money's going. But when you get hedged, that's where the money is going to go into your drawdown. So flipping back over here, we would have the 22 pips in drawdown, plus we would have our additional like roughly 44 pips also in the drawdown with the gain and the loss of that position. Now, let's say we wanted to try this again and put in another entry for a long, or even just going by the basic strategy, we're just going to try to recover our gain. At this point, all we would need to do is get that 22 pips up. So let's say that we were looking for that 22 pips to close our trade at this point. About close enough. And let's say it's going and getting everything consolidated. You're seeing maybe some small action or something after you've done closed your trade. Some kind of reason of why you wanted to close your hedge. You think a reversal is going to happen. But then as soon as you close your position and you think it's about to start to go up, then all of a sudden it drops out and you get hedged again. Well, this is going to be a real common scenario, especially if you're using like a tight stop loss or a tight hedge order. When you normally trade, this will typically happen. So what's going to happen from this point? You're now going to have another 22 pips in your drawdown. So we're going to have the 44 pips, and most people will usually track this in a calculator or something like this. I'll actually show you an easier way to keep up with this in just a moment, so you don't have to actually wind up writing down a whole bunch of spreadsheet of numbers. But you got about your 44 pips in your drawdown. So now you need to recover 44 pips in your next position in order to recover both of these losses. Now these aren't really technically losses because you have to realize them in order for them to be losses. They're just in your drawdown. Okay, so everything's going to be getting held right here. We're trying not to cross this point unless we absolutely have to. So we're going to not worry about that right now, and we're going to just look at how this next part is going to go. So let's say you want to give it one more try. You want to try at this level down here to try to get the rebound and try to make up that 40 pips, and maybe even try to get some kind of profit. Like you may want to try to come back and target this area, for example. That way you still get kind of a similar gain of what you're looking for in the first trade. This is a common extra step or an extra process to take. Usually it's much better done with a trailing stop. That's something you should probably try to get practiced with and try to figure out a good way. I usually wait for the next higher or low and then I go right above that. It's a pretty simple way to follow. But now, let's say for example, this size was like a 0.1 and this size was a 0.1. So if we're on the Euro USD, that's going to be $1 a point at that size. So you got basically the dollar a point rate that you kept up with here. But now what's the easiest way to calculate your risk from this point? So if price were to come on down here, you close out your other hedge that you had here, which was the size of both of these. So you close that out. Now you got a total exposure, and this is where risk starts to turn into being easier looked at as exposure, is you now have the 0.2 lot, the 0.1 here and the 0.1 here together is 0.2. So now instead of trying to say, okay, I have this risk here plus this risk here, and then if I add this, it's going to add, you're going to have just a string of numbers. All you have to do is figure, okay, if I want to make another 20 pip stop, all I would need to do is figure the pip value at this point would then wind up being $2 per point, so, or $2 per pip. So you just would figure that size as a normal trade, and then at the pip value for the distance of where your next hedge order is going to be. So that way, instead of trying to track a long list of numbers, you can just immediately look, okay, I've got a 0.2, I'm risking 20 pips, so that's going to be, I believe that's an additional 40, might be 40. Let me pull this up real quick. This is my risk calculator is called the Scalper's Toolkit. I'm not sure if it changed the name on TradingView or not. But if we were going with the 20 point pip size, make this a little bigger so we can see it here. There we go. And we are looking at, yeah, so we got a 0.2. So yeah, it would be 20 bucks, $20 added there. So let me not give the wrong numbers. So this right here is something I use a lot. Another thing I like on TradingView. You can set up the stop. This is figured in points, and then you can figure it off of a few other things. It puts your reward ratio, everything in there too. You can customize the whole thing the way it looks. Work out your account value. If I was trading euros, for example, it would automatically work out the new numbers and pip values. I really like the pip value thing that I pull out. I use that a lot. And then you can set your sizing to be automatic or manual and put your own sizes in. So that's a really helpful tool. I'm probably going to be using this a lot when I'm explaining some other things. And when I go to do back testing, I probably won't be able to use it as much, but I'll be using the pip value or something from that. So basically that would be the easiest way to figure your risk. And that's where you can kind of start looking at it more or less when if you're hedging. It's a lot simpler to try to look at it in terms of exposure instead of trying to work it all out as this is risk and then I did this here, that here, this here, that here. You are going to wind up with a spreadsheet a mile long in some of these positions, because if you constantly get things wrong, you could be in a trade for months. I'm actually working a few test scenarios, and I'll pull some of those up to actually show some examples later on, but some of those have gone for 8 months off of a $100 account and they're still not dead. So I'm going to definitely be using those and to try to show some of the advanced concepts. But right now we're still in the beginning. We're just kind of expanding on that basic hedge. I'm going to kind of wrap things up here on this video. Try to keep things short and sweet, but just keep that in mind, that whenever you have a hedge position, whatever you are trying to make a stop order for, that's going to be considered your exposure now instead of just risk, because we're not closing this out. We're just exposing more risk out of this equation. We're just going to use a little bit more of our equity to expose risk into the system. And if we start to make profit, then and start to make gains off of that, we can apply that to our drawdowns, which will then start pulling the drawdown and account value and things back to our equity. So in this situation here, for example, just to let you know how that's going to work. So let's say you don't get hedged here, and then finally price starts to come back. The drawdown from the first two hedges would start coming back, and then we just need to come to about right there or so, and then we can close that out, and we did exactly what we wanted to do. We make our little bit more. We avoided these two losses here, and we succeeded the initial position as far as the account is concerned in an actual profit. So that's one way you can take advantage of building on that basic strategy that I showed you, the basic hedge. So as you can see, it's still the same concept, and that's just showing it in one direction. In the next video, I'm going to get into two directions, and that's where it really becomes important to look at things in terms of exposure and not risk. Thanks for stopping by. I hope you got some kind of value out of this and kind of understand further about how hedging can be used to your advantage to give yourself another chance at winning a trade. Look for the next video here coming out soon. I'm going to go ahead and record it now and try to get these out together with just a little bit delay. So look for that video coming up soon for the second part of risk and exposure. And I'm going to talk a little bit more about how to calculate that actually based on from the beginning of the trade. So no matter how much this happens, you've already planned your risk from the first entry. So we'll get into that next time. Give a thumbs up, subscribe for more, and share this video with anybody you think who needs it. Really appreciated it. I help the channel get going, help more people learn about trading. and get more people actually understanding what's going on with their account while they're trying to hedge. So that way they can try any strategy, mine, his, hers, anybody's, and basically understand what's going on and know how it's going to work out for them. But I'll see you on the next one.